All right, let's dive into a head-to-head financial matchup between two resource companies, Westwater Resources and First Phosphate. Now, on the surface, one looks quite a bit bigger, but does that really mean it's better? We're going to use data from Analytica Investor to really get under the hood and see what the numbers are telling us. Let's get into it. So, imagine you had to pick one of these for your portfolio. How would you even begin to decide? It's a tough call. Today, we're going to treat this like a puzzle. We'll use the data you're about to see to piece together a really clear picture of each company's financial health and where they stand in the market. Here's how we're going to break it all down. First, we'll meet our two contenders. Then, we'll get into the tail of the tape with those big, flashy market numbers. After that, we'll zoom in on what it looks like from an investor's point of view, figure out who really owns these companies, and then wrap it all up with a final scorecard. Okay, first up, let's get properly introduced to the two companies at the heart of our comparison today. In one corner, we've got Westwater Resources, trading under the ticker WWR. And in the other corner, we have First Phosphate Corporation, which you'll find under the ticker PHOS. Two companies, both playing in the resource field, but as we're about to see, they have some pretty different financial stories to tell. All right, let's get to our tail of the tape. This is where we look at the big top-line numbers, the kind of stuff that gives you a first impression of how the market is valuing these companies and, how they're performing on a basic level. First up, market capitalization. This is basically the total value of all a company's shares. And right away, you can see Westwater Resources is the bigger company here, clocking in at just over $120 million. That's compared to First Phosphate's $91 million. But hold on, size isn't everything, right? A bigger price tag doesn't automatically mean it's a healthier company or a better investment. To really understand what's going on, we've got to peel back a few more layers. So now let's check out EBITDA. This number gives us a pretty good sense of a company's core profitability before all the accounting stuff kicks in. And, well, they're both in the negative, which isn't super surprising for resource companies that are still in a growth phase. But look at the difference. First Phosphate is at negative $7.7 million, while Westwater is way down at negative $12.5 million. So, at its core, First Phosphate is burning through less cash. And this story, it just keeps going when we look at operating income and free cash flow. Again, First Phosphate is less in the red on both fronts. That free cash flow number in particular really tells a tale. We're talking negative $6.6 million for First Phosphate versus a whopping negative $17.6 million for Westwater. That means Westwater is going through its cash reserves at a much, much faster clip. Okay, so this is interesting. Westwater is the bigger company, but it's also burning cash much faster. So let's switch gears a bit. Let's look at this from the perspective of an individual investor. What do the numbers tell us on a per-share basis? Before we jump into the next chart, let's just quickly define a really important term here, the current ratio. It's actually a pretty simple but powerful test of a company's financial health. All it does is compare a company's current assets to its current liabilities. The big question it answers is, can it pay its bills for the next year? Generally, you want to see a ratio above 1. And this is where the plot thickens, because despite that higher cash burn, Westwater Resources is actually leading on some key per-share metrics. Its book value per share is way higher, and look at that current ratio. It's well over 2, which is super healthy, while First Phosphate's is actually below 1. Westwater also has more cash on hand per share, so on paper, it seems like Westwater is in a much better position to handle its bills right now. So now we've got a real puzzle, don't we? One company burns less cash overall, but the other one looks stronger on a per-share basis. Let's look for another clue, and this time, let's see who actually owns these companies. That can tell you a ton about investor confidence and who's really in control. Let's just define two quick terms, free float and closely held. Free float shares, that's the stuff that you and I can go buy and sell easily on the open market. Closely held shares are the ones locked up by insiders. We're talking executives, the management team, and big-time investors who have a major stake in the company's long-term success. Taking a look at Westwater first, wow, you can see it's almost completely owned by the public. Over 90% of its shares are in that free float. Now that means there's a lot of liquidity, it's easy to trade, but it also means that insiders hold less than 10% of their own company. Now, let's switch over to First Phosphate. And the difference is it's stark. For them, closely held shares make up almost 31% of the total. This suggests that the insiders and the big long-term investors have way more skin in the game, which a lot of people see as a huge vote of confidence in the company's future. Okay, We've looked at the market size, the cash burn, the per-share health, and the ownership structure. It's time to bring it all home. Let's put it all together in our final section and lay out a really clear scorecard of the pros and cons for each company. And this table just lays out the trade-offs perfectly. With Westwater Resources, you're getting a bigger company, a strong balance sheet, and that really healthy current ratio. But the price you pay is a very high rate of cash burn. On the flip side, with First Phosphate, you get a much lower cash burn and high insider ownership. But you have to be comfortable with a smaller company and weaker short-term financials, like that current ratio being under 1. So what's the verdict? Who's the winner? Well, as you can see, there is no simple answer here. Each one tells a completely different story. Westwater's story is about a larger company with a solid balance sheet, but really high expenses. First Phosphate's story is about a more tightly controlled operation with a lower burn rate, but some definite short-term financial weaknesses. The better choice really truly depends on what an investor is looking for and how much risk they're willing to take on. So we've walked through all the key numbers, and now the puzzle is really in your hands. So I'll just leave you with this question. Now that you've seen the data, which one of these stories, which company's financial journey is more compelling to you, and why? Thanks for tuning in.